everyone, welcome to Infinity Wealth. My name is Dr. Marttand Patel, and today I'm standing outside the Bank of England because I want to talk to you about interest rates and how interest rates affect asset prices. You'd already heard in the news that the Americans have already reduced interest rates, and we are talking about reducing interest rates as well. These are things that are important when you're considering the property market. Now, when you're looking at the property market, as interest rates go down, they drive up asset prices, whether that's in the stock market or in the property market. So if you take a look throughout history, when we had the 2008 recession, during that recession, interest rates fell to near zero around the world, and in England to about half a basis point, basically. That increased asset prices. They'd fallen all the way from 4% all the way to zero, almost zero. Now, this increased asset prices. Where we stand at the moment is that the Bank of England and the banks around the world are in a bit of a dilemma. And this is the dilemma that catches them. If they increase interest rates, then this will mean that it will affect asset prices. They're caught between a rock and a hard place where they cannot really afford to increase interest rate prices. If they do, they'll have a collapse in asset prices, and that will lead to a worldwide recession. So they haven't got much ammunition as far as the next recession is concerned. If the next recession arrives, they are talking about having negative interest rates. Now, around the world, you've got $12 trillion worth of negative interest rate debt, sovereign debt. Now, what does that mean? If you were in Japan and you had money, where would you put your money? The main problem is that if you lent it to a sovereign government like Japan, they would give you negative return. They would do the same in Europe. So the only other asset prices that we can look at as investors are either the stock market or property. Today we're discussing property and how you can take advantage of some of the lower interest rates, and you have to be very skilled at doing that. Okay, so how do you take advantage of the low interest rates? Now, currently, there's different strategies, and what we will show you is how to implement those strategies. Whether you buy the houses in the north where you get better yield, or you buy houses in the south. Currently, the UK market is suffering in the southeast, whereas in the northern part of England, where yields are better, it's rising. So you need to actually educate yourself more in understanding what the market is developing. That way you can take advantage when it's there, present for you. The other advantage of having negative interest rates or low interest rates, and how you could take advantage, is using potential JV partners. Because these potential JV partners, as we discussed before, they've got money in the bank, but they don't know how to actually generate a better return. And this is where you, as an investor, with some of our help, can come in and say, actually, I can help, and it create a win-win situation. So take advantage of such low interest rates, because there's going to be a wealth of people who have got money tucked away that have got negative interest rates, and they'll be paying to have their money stored here. That's something that you don't want. So try and help them. Okay, the other thing about the property market is, I've heard a lot of people talking about Brexit and how it's affecting the property market. Governor King, the former Bank of England governor, actually put it right on the head. The main problem is that other countries around the world are also experiencing a property decline. They're not in Brexit. The reason why is the worldwide economy is slowing down, and that's why it is. Obviously, Brexit may affect the UK property cycle a bit more. But then what's helping the UK is that sterling being so low is encouraging people to actually invest in the London property market and in the UK property market. So you've seen foreigners who come in and buy up loads and loads of commercial property in London. So recently in the Financial Times, there's a consortium that are buying the South Place at the moment for 875 million pounds, giving them a yield of about 3.5, if I'm correct in that. But that is a positive sign where foreigners are encouraged to come into Britain to invest. Now, with interest rates being so low, there is a flaw under this property market. The only way this floor will be disturbed is A, if there is a currency crisis, in which case interest rates have to rise in order to support the currency. Otherwise, a lot of people actually realize now, which is why they're pumping money into buying bonds, because they anticipate interest rates going even lower. So if these guys are buying it on the facts of going lower, you have to understand that there will be a time there is a perfect opportunity. Now, the best way to position yourself is really to understand what is going on. Then you can take advantage. A recession is a good thing. To any investor, it cleanses the market and it gives entrepreneurs an opportunity where they can come in and make some decent profit very, very quickly. Now, if you stay with us and follow us, don't forget to hit the like button, subscribe button, and follow us regularly on our videos. We will bring you free information to help you help you find out what to do next and what steps to take next. So please follow us and remember to share and like the video, because that's how we're going to grow as a community. Okay, I hope you found the video very interesting, and I hope you enjoyed being around the Bank of England and seeing, it's actually at Threadneedle Street. We're here on a Sunday because normally during the day this place is packed, full of bankers. Okay, so I hope you've enjoyed it. Please stay in touch and we'll see you in the next video.